Hello everyone, and welcome to the Subservicing Scene. Today we will be focusing on automatic PMI terminations with considerations for both lenders and servicers. I'm Mignon Davis, and I'm joined by Jen Hughes. Together, we run Subservicing Oversight here at Richey May. All right, let's dig in.
Thanks, Mignon. The first thing to understand is that the automatic removal of PMI is required when a homeowner reaches the point where their mortgage balance is 78% LTV based on the amortization schedule. This means that once the customer has paid down the mortgage, where the balance is less than 78%, the servicer is required to automatically cancel the PMI, provided that the loan is current.
Does this mean that the automatic removal is based on the amortization schedule rather than the current market value of the property?
Exactly. The amortization schedule is used to determine when PMI should be automatically removed. This ensures that homeowners do not have to continue paying PMI once they have paid off a significant portion of their mortgage.
So let me play this back to you. For automatic termination, the loan must reach 78% loan to value per the amortization schedule. If a customer pays down to 70% in the first couple of months of the loan with additional principal curtailments, the PMI will not auto terminate. The customer would need to formally request that their loan is reviewed for PMI removal. Now let's talk about customer requested removal of PMI and how that differs from automatic removal.
Customer requested removal allows homeowners to request the cancellation of PMI once they believe they have reached 20% equity in their home. To do this, the homeowner typically needs to submit a written request to their servicer. Depending on the servicer's policy, the servicer may require an appraisal or BPO to verify that the current loan-to-value ratio has indeed reached 80%. Unlike auto removal, this process can be initiated by the customer, provided the equity threshold is met.
Can you give me an example of what could cause the customer to reach 20% equity in their home earlier than expected?
Yes, an example could be that the customer makes home improvements or if there is a property value increase in the area. It could also be due to the customer paying down the principal balance by making additional principal payments.
Keep in mind that there are some other requirements depending upon if you are in the first 5 years of your loan or if your loan is past that 5-year mark. It is important for servicers to work with their customers to determine if they are eligible to remove PMI. Jen, what should servicers do to ensure their staff is able to adequately help customers through this process?
Servicers should have written policies and procedures that outline the conditions. One condition is that the loan must be current. The servicer may also look into the payment history to ensure that there have been no recent delinquencies. Additionally, the property value needs to be verified, often through an appraisal, as mentioned earlier.
Great point. Servicers need to have clear policies and procedures around the PMI removal process for both auto terminations and customer requested terminations. Policies should include what documents are required for customer requests. Auto terminations can be done systematically in the servicing platform, but compliance and internal audit should regularly test the auto terminations to ensure the system is working as intended. Compliance and internal audit should also regularly test customer requested removals to ensure the servicer is following CFPB guidelines as well as internal policies and procedures. Lenders should have a process in place to ensure their subservicers are following these CFPB guidelines as well. Thank you for your time today, and we hope you found this information beneficial. If you have any questions or would like to discuss how Richey May can help you, please contact us. Next time, we'll dive into another one of our subservicer hot topics. Stay tuned for that, and we'll see you next time.